guess I will go ahead and get started. My name is Maggie Kulyk. I am the CEO and founder of Chicory Wealth. And here we are, Tuesday, September 16th, 2025. What are we? Maybe like, uh, how far are we away from falling back, Liv? We're falling back here pretty soon, aren't we? Another week or two?
Soon, yeah. Let me take
Yeah.
a look at that.
Yeah, we're about to be to fall and we're about to fall back. I I I was reflecting on this morning and thinking it to me one of the hallmarks of the ineffectiveness of Congress is this very issue. Everybody agrees we should just be left alone, but nobody acts. Can't even get that, can't even get that over the line in terms of legislation to just like stop the madness on the time change. But what are you going to do? Um, Gosh, there's a lot I could say this morning about our environment, um, and I'm tempted to, but I also have Josh Hile here, so I'm not going to opine too much on our overall situation. I will say a few brief things about the market before we turn our attention to the topic for today, which is non-publicly traded impact investments. And Josh is our resident expert on that. As you well know, if you've been paying attention, the market continues to want to go up, and it's very excited about what appears to be an imminent interest rate increase of 25 basis points this week, which is arguably well priced into the market, and maybe even more is priced into the market. Um, Depending on where you sit and where your optimism is around artificial intelligence and its capabilities. The market is either tremendously overvalued or at least some overvalued by most measures. I heard this morning, I listened to Bloomberg quite religiously, that the broader S&P is about 30% above its historical average. The so-called Mag 7 is about 40% above its historical average. And but um, there certainly are companies that are producing cash, quite a bit of it. The earnings reports continue to be pretty strong. The job situation appears to be deteriorating, so there's room to cut, but inflation continues to be an issue and likely hasn't come all the way through the system. Uh, and the tariffs are impacting things. I'll give you a direct example. I ordered a device from Germany that I use. It's a electromagnetic pulsing device. It keeps my arthritis in check. I have ordered one before about 3 years ago. It came through in about 4 days. It has been 2 weeks now. I've been trying to follow up, and it is stuck in customs. Can't get through customs. It's a device that's come back and forth, but I don't know what the implications of that are. I don't know if I will get a bill for a tariff bill on that or how it's going to work. It'll be a curiosity. I'll report back, but I know that the thing has been, UPS has now pushed back the delivery date 4 times because they can't quite get that thing through customs. So just a little anecdote about one small thing that may or may not be significant. It's certainly significant to me, but such is life. So with that, I want to introduce Josh Hile. Josh, we have been working together. You've been working together with Chicory Wealth now for about 3 years. Is that correct? Do you have that? We
That's
clocking
about
that
right.
right?
Yeah.
Yeah. And just to frame, I'm going to let Josh introduce himself and his background, but just to frame what we're talking about today, we're talking about Josh runs a plant farm called Citizen Mint, and it gives us here at Chicory access to offer investments to those of you for whom it is appropriate in non-publicly traded types of things. So, infrastructure projects, real estate, et cetera, but things that do not trade in the public markets and historically have been the purview of, I would say, like historically ultra high net worth individuals for the most part and institutional investors. Um, and so it has not been very easy for us to find ways to get our clients exposure to this until Josh came along and gave us an opportunity through his platform, which we have used quite a bit. And some of you probably on this call have investments through Citizen Mint, through us via Citizen Mint. So Josh, I just want to start by asking you to give us a little bit of the narrative of how you got into this, how old Citizen Mint is, and the why of it. Why did you decide to start this thing? And just say more about what you're doing and why you think it's important for what you think it's important for us to know.
Yeah, definitely. Just to give you a little bit of my background. So always been kind of on the investment side of things. Started my career at Deloitte for a few years, then was at Russell Investments, which is a big institutional asset manager. So I was in their manager research department, helping big institutions manage their capital, like AT&T, Boeing, Microsoft were some of my clients. And then I left and joined a large wealth manager in Seattle called Laird Norton Weatherby. We were about 16 billion in assets. I was the director of investments there for 5 years. And then, and we had a big focus on impact and sustainability as part of our ethos. So we had a lot of clients who cared deeply about the environment, social issues. And then I left to start Citizen Mint. And we work exclusively with wealth advisors and family offices to essentially provide them access to these different opportunities, mostly in the private real asset space. That's been our focus. So infrastructure, private real estate, senior secured debt, places where we believe there's income generation, downside protection, real diversification for portfolios, but then also this impact that you can have within those areas. Like if you think about, like a lot of people ask us about our name, and it's like Citizen.
Yeah.
What does that
Yeah.
actually mean?
What does that mean? Yeah, exactly. Right.
And so, Mint being like known for like money in some form or fashion, and citizens being like, we're all global citizens, and we should do good things with our capital. It's not going to be government who solves these issues. It's going to be us collectively putting capital to work in places that can solve these issues. On the backside of that, we do believe that there is still this risk return metric that we have to hit for clients to be fiscally responsible. So we aren't necessarily concessionary in what we do. We are trying to provide very strong risk return for the clients, but have this kind of positive impact in the number of areas we work in. So, energy transition, workforce affordable housing. We also work in like other parts of market, like whether it's in organic regenerative farming, even like social impact related to, like we did an ESOP fund earlier this year where it's providing employees the ability to garner significant benefits that they wouldn't have garnered in a normal corporation where they're just a manufacturing line worker, but in this situation they get equity in the company and get like a 6-figure exit in most cases. So those are the kind of places we focus on.
I want to just reiterate a couple of things for a lay person, right?
Yeah.
When we say the return is not concessionary, what that translated means, we expect you to make real money, the same kind of money you might make if you were investing in something that didn't have a social impact, right? And because I think that's important. I think there is still the assumption that if you're trying to move capital in a way that is that really uses the lens of positive impact for communities or the environment, et cetera, that it by definition means you are conceding what you're going to make on it. And so you're looking for deals where you're quite certain that's not the case.
Exactly. We just don't, we believe you don't have to be concessionary. I mean, the issues that you're solving here are massive opportunities. If you can look at it as issues or opportunities, and so we decided
Problems or opportunities,
we
right? Yeah,
decide to take
right.
the optimistic lens of saying these are big opportunities and big issues we need to solve, and somebody's going to make money solving them. And so why not us, like making money solving these massive issues? And because they are massive issues and they're going to come to the forefront at some point in time. So we're part of the solution to those problems.
Right. Right. And is it fair to say you got, I mean, say a little bit more about Citizen Mint in terms of, how you find these opportunities.
Yeah.
One of the things importantly for those of you who are on the call who are clients of Chicory Wealth, I very frequently refer to our client base as like garden variety millionaires, right? Meaning folks who have, money, but not like tens of millions of dollars typically. We have some clients who have significant money, but most of our clients have, they've earned their money over their lifetime. They maybe were just really good savers, etc. And so they can't invest in a single deal that's $500,000 or $1
Yeah.
million, which has been the typical route in the past for these kinds
Yeah.
of opportunities. How is it you're able to get some of our clients, give us these opportunities for 100,000 or 50,000? Why can you do that?
Yeah. So it depends on the opportunity. But like
Mhm.
what we try to do is like I have a pretty massive sourcing network essentially. Like, I built it up over time. I've talked to a lot of people, had hundreds and hundreds of meetings per year to essentially build up this extensive sourcing network where I know a lot of people within the industry, they know me. And it's kind of this trust relationship where it's like, Josh is going to do what he said he's going to do, and he's going to raise that $5 million that I expect him to raise on this.
Mhm.
And so they come to me with different opportunities over time. We pass on a lot of the opportunities that we look at, just because they just don't meet our criteria of like too much risk or just doesn't, like something there doesn't feel right or something, like my auditing skills back in the day. And then, we are able to like co-invest with very large asset managers and provide these opportunities to our investors. And so we aggregate capital in one vehicle, which allows us access to these, because they don't want to take these big institutional managers don't want to take capital from like individual little checks. They just, because it's a big hassle on them, they want to do what they do best, which is invest. And so we're on the backside of that saying, okay, well, we can build technology. And so, my co-founder is fully technical, built out kind of our technology platform to allow it to make it super simple for us to aggregate that capital and provide it in one check to the ultimate asset manager. And on the back end of that, provide it both to, also to a lot of accredited investors. So we try to do as many things as we can for accredited investors. Now we have to work within SEC restrictions around that and kind of the guidance that we get. But to the best of our abilities, we're trying to lower minimums and allow it to accredited investors.
Right. And to be clear, folks, an accredited investor, and correct me if I don't have this precise, Josh, I think I do. An individual has to be making, if it's an individual, more than $250,000 a year. If it's a couple, $350,000 a year, or have a net worth greater than $1 million, not including, I believe, a primary residence. Do I have all of that right? Did I catch all that, or did I
I
miss
think
something?
it's 200,000 on individuals and 300,000 on
Oh,
couples.
okay. I added
Yeah.
50K.
Yeah.
Okay.
And
We
then
like to be conservative around here.
yes, yes. And then the $1 million,
All right.
yes. That is part of it. And then there's other certain things they've added in. If you have certain licensees now, you are considered.
Yeah, like if you're somebody like me that's a
Yeah.
professional and
Yeah.
theoretically knows what I'm doing, then right, exactly, exactly. And one of the other characteristics about these types of investments, for those of you who have not ever invested in them, is that they are typically illiquid for some period of time. Can you speak to some of that, the illiquidity range, Josh, and sort of why something might be illiquid and how it gets liquid over time?
Yeah. So yeah, these aren't publicly traded stocks or bonds where you can trade them in and out and there's an active marketplace for them. These are things that usually take time to mature in a lot of cases. And so as basic examples, like say you're investing in a real estate project and you're building a ground up development. So you put in $50,000 into that ground up development. They need to build the building. They need to fill the building with residents. And then at that point in time, the building has real value. Until that point in time, like, you know, there's no active marketplace where you can sell that because you can't determine the value at that particular point in time. Is it what you put in it? Is it lower than what you put in because it's still building and there's risk involved? So in many cases, like you need to wait to the fruition of like something happening and the building and the value of your investment increasing dramatically, which is both at the completion of the building and then at the filling of the building with residents. And that's just like a very basic example. In most cases, our investments can be between 2 years to 7 years. Some can go up to 10 years, but we try and keep it in that 2 to 7 year range in most cases, just because we feel that that's the range that investors can withstand illiquidity. Now, as part of an overall like diversified portfolio, you can have part of your portfolio in illiquid assets. Like it's okay. Like usually I like to talk to investors. It's like, it's okay. Like you're not going to probably sell your stocks when they're down 20% if it's a bad market environment. And you just incorporate that into like how you're thinking about the overall portfolio. But like having like 5%, even up to 10% of your portfolio in illiquids, that's okay in most cases.
Yeah, I've begun to wonder if even, I mean, this is not advice for those of you listening, the SEC or our compliance officer. This is not advice, but I mean, it has crossed my mind that the illiquidity bugbear is just that we probably can withstand. Most people can actually withstand more illiquidity, depending on the amount of assets they have, where they are in their own life cycle, how much they're drawing down their assets. I mean, we certainly have people who are in well into their retirement, but it happens that for other reasons, Social Security, pensions, relatively modest lifestyles, they're actually not drawing down on their portfolio much at all. Versus someone where it's a very active draw out, and that's a completely, so it really just is, it's very particular as to how much illiquidity an individual can withstand.
Exactly.
Yeah. So tell us a little bit about, like, give us an example of an investment, even one that's maybe just even something that's closed, that's no longer possible to invest in, that you just really loved. You were just saying, you just thought this is great. Here's why it's great. It's doing this great thing, and its risk return characteristics were awesome. Just give us an example of that.
I mean, there's so many. I love it.
Okay.
This is the best part of my job is the investment side. So we did a couple investments here that the Chicory team knows about well. But it's something that most people have never heard of, like even professional investors have never heard of it. So I love it. And it's called interconnection queues. And this is something that from a risk return perspective is one of the best risk returns I've seen in the marketplace. And so what interconnection queues is so when you want to connect to the grid, say you have a power asset, whether it could be a carbon power asset or a renewable power asset. So it could be
okay, so layman's terms, like a bunch of solar panels or
solar, wind, batteries, geothermal, natural gas, any of that is a power asset. And so when you want to connect that power asset to the grid, you have to go to the utility or the utility authority, which could be a broader utility. And you say, hey, I want to connect to the grid. And they're like, sounds great, go get in line. And these lines are 12 to 36 months long. Because essentially what they have to do in the meantime is figure out engineering, because it's not like you're going to go and just plug in and it's super easy to your like you're building a house and you're just going to plug into that what's going on your street. That's just not how it works, because these are big power assets. And so because they're like, okay, well, it costs $1 million a mile to build 1 mile of power lines. They might need to put a new substation in that area to handle the load that you're going to bring to the power grid. So they say, okay, well, but if you want to get in line, we'd love to have you in line. But if you want to get in line, you have to put down a deposit right now at this moment. And these deposits are between $1 to $5 million. They can be much higher than that, but usually they're $1 to $5 million. And the deposit is essentially how much is it going to cost to do what we expect it to cost to build this. So like how much is it going to cost to build those power lines, substation, whatever it might be.
How much is it going to cost the utility
Yes,
to create the infrastructure to allow your power array to come into the grid? That's
exactly.
the right. Okay.
Exactly. Yeah.
Mhm.
So, and why they do that deposit is because they don't want speculators in the line who get to the front of the line who can't pay it. And then they did all this
Mhm.
work on the back end, and then they realized that like these
Yeah.
were just speculators. And so what happens is like for a developer of these power assets, they're like, well, that's a lot of working capital out the door instead of going to get new permitting for other assets we can build. And so they say, okay, well, is there somebody who will put down that deposit for us? And we say, yeah, we'd love to. And that will be 14%. So we're going to charge them 14% interest to put down that deposit. And it's 6.5, these are usual terms, but so
Mhm.
it's not every case, but it's like usually around 6.5% current pay. So they're paying us on a consistent basis. And then 7.5% deferred. So when the project gets to the front of the queue and they sell off the project, usually, then we get paid back. We also get a 2% kicker on usually our loan, essentially, that says if the project gets approved and sold, then you give us a little bit of that profits from that project getting approved and sold.
2% of your profit. Okay.
Yeah.
Okay.
Now,
And go. Yeah. Go.
how
Keep
we
going.
protect ourselves on these. Is these are fully refundable deposits almost in every case. Not every case, so you have to be careful, but in most cases, these are fully refundable deposits. And maybe they take off a little bit off the top for some engineering fees that they did up front. However, what we do is we put in 85 cents on the dollar and the developer puts in 15 cents on the dollar. And so what that allows us to do is if anything goes wrong, the developer goes bankrupt, the project's not going to go through, we pull our capital because it's in our own escrow account that we control. And then we take our interest rate from the 15 cents that the developer put in over that time. And so however long our money's been in there, and then we walk away, say,
Okay.
thank you, we got our money, we're returning our capital to clients, and we're giving them their interest rate as well. And then, but that's a very low risk to return opportunity that we just love.
Yeah. 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 And so just to be clear, like for example, the deposit that these entities have to make is a deposit they have to make to somebody, say like Georgia Power, right? I mean, it's like big utility or Duke
Yes,
Energy
yes.
or okay, got it. Yeah, I
Yeah,
know. I mean, just at a tiny scale, I have solar panels on my house, and when I wanted to just like plug into Georgia Power, it was like 3 months before Georgia Power could even go like, yeah, you can. I mean, I'm like generating like tiny amounts of
yeah,
energy, right? Relatively speaking, but yeah,
yeah.
okay. Interesting. And the people who are out there doing these, I'm curious about like the people on the other side who are on the deal, these developers. Um, you know, who I guess how do I want to phrase this? Who are they? Like what are they up to? Who are they out there doing
Yeah,
solar arrays or geothermal or whatever? And how
yeah,
are they getting paid? Once they get into the grid, how does that work for them? I'm
yeah.
curious.
So essentially what these developers do, so there's multiple ways. Most of them are community solar developers in a lot of cases. And a community solar developer just means that they're going into a specific community, usually signing some kind of long-term lease with that community for power generation that's going to be like stable power pricing for that community over time, because what we do know is power pricing is going up from here. But what the developers do is there's a three-legged stool to their return profile. So they need to do three things. They need to acquire land or lease land. They need to sign a power purchase agreement, which is somebody buying their power for the next 20 to 30 years.
Okay.
Whether it's, a big tech company or a community development or the local utility. It could be number of people, but sign that power purchase agreement. So essentially they have an off taker, they have the
Mhm.
land in place, and then they get the permits, which can take 5 years. And then the last part of that is getting the interconnection. And so once they have those things, and lands and permits are essentially the same thing, but once they have those three things, they can sell off that project. So they usually most developers actually just sell it at that point. They don't actually construct it, because you've essentially taken out the whole risk of the project once you have permits, an interconnection queue, and your power purchase agreement. Because the building of these projects is rather simple. Like putting in solar arrays is rather simple. Putting in batteries is rather simple. That you don't have much construction risk. So somebody else comes in and buys that project from them, actually constructs it, gets their kind of return on that construction project, which is very different than the developer. The developer is looking for like 3 times their money, very high IRR. And so our cost of capital of charging them 14% isn't that much for them to like that.
They're making way more than that.
They're
is what
making
you're
way
saying.
more. Yeah. Yeah.
All right. All right. And
So
who
they're
are they
willing to pay
selling?
it.
And who are they selling to? Who's buying?
Usually larger infrastructure players within the market. So, like think of like 200 to billion-dollar companies who are building these projects out and putting them in a portfolio. So it could be both like bigger asset managers who are building these out, like to the biggest extent, like the Brookfield, the Ares, the Blackstones, the BlackRocks of the world, who have multi-billion-dollar funds, usually 20 to 50 billion-dollar funds, who are like, they might be too big for a lot of these actually, because these are like smaller, but then there's this middle range of like developers who are essentially like buying from these guys who are kind of like picking off certain land deals and stuff. So
what you're telling me is there is a whole lot of money in power generation.
So much money.
So much money in power generation. And is it fair to say that these power generation entities are incentivized to use the most cost efficient power? In other words, there is like, is it fair to say that the market is tilted towards power generation that is a little bit more sustainable just because of cost effectiveness of it, or is that not necessarily the case?
Oh, it's solar per electron is the most cost effective part of the market by far. But it's not even like I mean, you can point to natural gas and it's still twice the cost. And you have the secondary issue with natural gas of being able to even like acquire a turbine. So a turbine is made by like 2 vendors in the world, and these natural gas turbines, and they're sold out until the 2030s. And so
interesting.
Yeah, and most of those are sold to AI data companies who have purchased every turbine in the world, and will be putting them on the side of a data center.
Yes, thank you for that segue. Okay. Right. Perfectly timed. Thank you, Josh. You didn't make me have to leap over to it. Okay. Yeah. So let's talk about why there's so much money to be, sloshing around on the energy side, and AI, what it means as far as you are concerned, and how all this intersects with the most recent legislation that passed, the so-called VBB, which I can't bring myself to call it, but you know what I'm talking about, and the sunsetting of certain tax incentives. Can you help us put that picture together?
Yeah. So let's start with just the subsidy changes. So here, I'm going to bring up some things. So can you all see this?
Yes, now we can go for it.
Yeah. So the OBBB brought in new changes to the law, really focused, and the biggest focus was, it got rid of EV incentives. Okay, a deal, but not that big of a deal in the grand scheme of things. It got rid of some solar incentives and wind incentives, but this sunset earlier. And just as a reminder, and let me take a step back from just to put a more optimistic view on this, because you see certain articles
Please
that might
hit
have
it.
a pessimistic view. Most of the managers I've talked to who are impact renewable managers are actually okay with this change. Just to give you some context, they're, inflation reduction. So the original incentives back in the day were supposed to phase out in 2023. The IRA brought them back into play and put them to 2032. So that's just the history of it. So they were supposed to already phase out. They brought them back, put them to 2032. Then the new law is gonna like phase them out again. And so, but now that the OBB is passed, it takes away a lot of the risk within this like particular part of the marketplace. But because before it was like, willy-nilly, we could get cut at our feet like on a day's notice. And now that it's passed, it's like, hey, we have probably 2 years of like what's going to happen.
Certainty. We have certainty, or have certainty.
So we can make investment decisions at an appropriate pace. And so I will tell you in general, like most people are like, okay, we know the rules of the game and we know how to play. And that's the biggest thing they care about, is just knowing the rules and knowing what's going to happen over the next like year and a half.
Okay.
So for solar, it's essentially you have to have projects in operation by 2027. You have to have, so they need to be placed into service and put on the grid by 2027 to take advantage of the full range of ITCs. So for
ITCs being
investment
tax credits,
credit, which is a big portion of the subsidies. And then they also need to start construction before July 4th of 2026. That's an important deadline. And so, for our managers, they're like, okay, let's roll. Let's just get them all under construction and so that we can take advantage of all these tax subsidies. So that's for wind and solar. And solar, like wind. So you've obviously seen in massive headlines around wind and kind of like trying to essentially it seems like the Trump administration is trying to pick off every wind thing. Wind is less cost effective in general than a lot of the other parts. Like there's certain places where it can be relatively cost effective, but offshore wind is really hard to make the numbers work without subsidies. And the reason for that is like, if you think about it, if you're trying to repair a massive wind tower in the ocean,
at sea,
you have to hire a boat captain. You have to go out to sea with multiple engineers. Like that is an expensive thing than going to the middle of Iowa, which has a massive amount of wind, and like getting an engineer to go up and repair it. So just the numbers are a lot harder to work on offshore wind. So we'll just get that out of the way. Thinking about it from an economics perspective. Now, so there's this solar, batteries didn't get touched. Awesome. We really needed batteries not to get touched in this. ITC transferability, that's investment tax credit transferability. So that's your ability to go sell those tax credits to somebody else. And so that you can, get money back on your investment. That didn't get touched. Huge. Then there's these FEOC requirements that are going to come into play, which is related to no foreign governments or no government, like it's like China, Russia, North Korea can't invest anything related to our energy grid. And then there's still some determinants around like how much of the parts you can use from other countries. And the reason for that is like mostly like it's like, are we always going to be dependent on China for solar cells and battery cells? Or are we going to be able to manufacture that in the US? And obviously they're trying to push people to manufacture it in the US, but there's still a lot of guidance that hasn't been formally, like even like Tesla batteries, all those cells are manufactured in China, even though it's like a US company, kind of as an example. There's still a lot of like work to be done there and understanding what those guidance. So we're not even going to touch on that for right now. That's not the big deal.
We don't know really where that's coming.
Exactly.
Okay.
This is the basics. So then there's what's the actual impact of this? So you're going to see a lot of things come online over the next couple of years. So you're going to see everybody accelerating their timelines of how fast they're going to get things on the grid. And then there might be a downward push on renewable energy projects canceled. And some of those projects should have been canceled because the numbers didn't pencil without subsidies. And so it was like already on a thin margin where you're like, you could maybe make money, you might not be able to make money. So those are the places where I'm like, well, if it can't be economically viable, should they be going forward with it? Essentially, if you're putting solar in a place that shouldn't have solar, or wind in a place that shouldn't have wind. We'll see if those cancellations are as big as we expect. What most managers expect to happen is actually energy prices to make up for that. So when you're signing a new power purchase agreement, the energy prices are going to be significantly higher on those power purchase agreements going forward to essentially
Meaning, okay, so
compensate.
just to translate that, I think what you're saying is even though the tax credits aren't going to be there, energy costs are going to spike high enough that these projects are actually going to pencil
Exactly. Yeah.
without the tax
Yeah.
credits. And this you've said now several times, energy costs are going up.
Yeah.
They're going up. And they're going up because of, I mean, is it just AI?
It's the three big things is AI. AI is going to be the driver of a lot of this, but it's also onshoring and manufacturing. People don't realize how much energy manufacturing takes. It takes an insane
Yeah.
amount of energy to manufacture stuff.
Yes. Yes, it does.
And so, Apple has announced $600 billion in manufacturing investments, 600 billion. And that's just the tip of the iceberg. If you see Apple doing it, it's like, and investors have rewarded them for it. And so if Apple's doing it, then you probably are going to see these other companies start to do that as well.
Mm.
So manufacturing and then electrification of everything. So you think like electric stoves, electric heaters, heat pumps, kind of everything moves to electric over mostly natural gas over time. And so those are three big, like, and EVs, like, as part of that electrification of everything. But those are three big drivers of this increase in energy. And we have a chart in here that shows energy growth over the last 25 years has been less than like 1% a year. And then you see it dramatically increase. These are the expectations of how much energy is expected to increase. So 75%. So that's an insane amount of energy. I mean, these are like,
That's a very high electric bill, my friends. For those of you keeping score on your bingo cards at home, if you can throw some solar panels on your roof, you might want to get on and do that, even without the
yeah.
tax incentives. I don't know, Josh, what do you think?
I mean, they're going between, yeah. I mean, it's like energy prices across the US this last year went up between 6 to 12%. And the expectation is that it will probably go up between 6 to 12% for the foreseeable future, because
So that's a compounded 6 to 12% for the
per
foreseeable
year.
future. Wow. Wow, wow, wow.
Because I
Okay.
mean, like, and so like you can even throw in like, okay, let's get microgrid nuclear on the like part of this, but it's still like real microgrid nuclear is still 10 years out from even being part of the solution, just because it's going to take so long. Like, you have to get community buy-in, you have to prove that it's safe, like, and it looks safe, roughly. I know everybody has different opinions about it, but it looks relatively,
No, but yeah.
it's going to
Yeah.
be part of the solution. But even with that, it's going to be tough to keep up. So, and to a second part of this is just, and this is what can give you optimism. You
Thank you.
see 70% of new electricity generation came from renewables last year. Actually, it was more than 70, it was 87%. Because if you wind, solar, 87% of new electricity generation last year was from, or this year will come from, wind and solar. And Texas is the biggest renewable energy state in the US.
I know,
think
the irony. Yeah.
it's going to surpass, because I mean, it makes sense. It's like West Texas. It's like you can put a lot of solar panels out there and you produce a lot of energy, and they need a lot of energy in Texas. Like, you can look up ERCOT, which is the Texas Power Authority, their daily mix. I guarantee you, like, and it will show you, look up like ERCOT daily mix, and it will do over 50% of their energy probably produced at this very moment is coming from renewables. And they're okay with it. I mean, here, I actually have it up, so I'll bring it up. So you see solar is currently 40% of their, this is real time. Wind, 7%, power storage comes on at night, but power storage is becoming bigger and bigger part of that. So yeah, it's really interesting.
Power storage as in batteries that are capturing what isn't being used.
Exactly.
And allowing it to, yeah, right. Got it.
Yeah.
Got
so
it.
that will be a nighttime thing where it, you know, solar during the day, wind will also be at night too, because a lot of wind comes through Texas at night. And this, yeah, this is another chart on just a massive amount of demand. So, and actually I will, so let's put a pin in this, but the overall, and then I kind of want to talk about really quickly data centers, because I want to.
Oh, I was hoping you would. Yes, yes, do that. Yes.
New renewables are still going to be the lowest cost of power, and lithium prices, even after all this stuff, have gone down pretty significantly, which actually is a boon to, it's like, okay, well, where are we to get power from? And it's kind of like, as these prices tip over, and like even like solar prices continue to go down and down, it's like it just becomes more and more cost efficient, because, you know, the big knock on solar was like, well, it's intermittent, and it's like, well, lithium prices are going down, we put more batteries, now it's not intermittent, now we have kind of the batteries at night, solar during the day, and you kind of have this grid stability. But new renewables will still be the lowest priced, like for the foreseeable future, unless something else happens where there's a new energy source out there.
Fusion.
Yeah, possibly, but still, again, 10 years away.
Oh yeah.
Yeah. Marginally economic projects are likely paused or abandoned. So things that probably shouldn't have been built are probably not going to be built. More natural gas is going to be used. That's what's going to happen. There's going to be more natural gas used, especially just to produce enough energy for the AI data centers specifically. But utilities, corporations, and states with decarbonization goals will keep supporting these kind of like renewable energy builds, like you see like Washington, California, a number of other states leaning into it, where they're like, we're still going to support this and like provide incentives for it. I think the biggest impacts that you'll probably see is like the tariffs, you know, that creases supply chain issues with like where you're getting these things from. Mostly they come from China for like our solar and fuel cells. So that's going to increase cost. It also could be like turbines from Europe. Like GE makes turbines, but there's a massive European company that I'm blanking on, might be Sonova or something, that makes turbines as well. But that could also hurt some competitiveness. And then offshore wind is probably not part of our solution going forward. It makes a little bit more sense in Europe, where you have, especially where they currently have it in Europe, just because Europe doesn't have natural gas resources unless they're taking it from Russia. And so it's a very different like cost effectiveness for them. And, you know, when you're putting it offshore in countries that don't get as much sunlight during winter months, but get a lot of wind, that can make a lot more sense. So, so let's talk about just data centers. So data centers, you know, the newest data centers are usually above, like these big data centers they have to create to power these NVIDIA chips are huge. I mean, you're talking 200 megawatts to a gigawatt of energy necessary to power these data centers. And
just to put that in context, right?
So,
like 200 megawatts is like Atlanta or something. Is that what you say?
To power Denver, it's 300 megawatts.
Per.
So 300 megawatts, like, it's just like, that's how much you need to like power the city and surrounding areas of Denver, Colorado.
Per day.
Yeah. And so these data centers are taking a similar amount of energy for AI. And so just by 2030, and this actually might go up, so that's the scary part. just US data centers alone are going to be the 7th largest energy consumer in the world. Just our data centers. So ahead of South Korea, Canada, Germany, France, just US data centers. They'll be
And just to
powered.
put just for those people who like, well, data center, that's a very nebulous concept. That's a building with a whole bunch of computers in it, right? Running the chips that are doing the artificial intelligence. I mean, very flat-footed definition, but do I have
Yeah.
that right, Josh?
Essentially, I mean, running every application on the internet essentially at this point, through like the cloud and holding all of our data and doing, these AI calculations. So every time you use ChatGPT or Claude or whatever else one you want to use, they're utilizing significant amounts of power.
Okay. So it's not just Bitcoin mining these days, eh?
No, it's not Bitcoin mining.
In fact, it's okay. All right. All
So
right.
yeah, and I mean, Mark Zuckerberg even came out with like the quote, like which is in the bottom left-hand corner here, but it's like energy, not compute, will be the #1 bottleneck for AI.
Right.
Because it's just you need enough energy. Like you can get NVIDIA chips, but you can't always get as much energy as you need for these like big data centers. So and they're just getting bigger. I mean, like a major reason these companies are, all the big tech companies are laying off, which is like partially related to they can automate some of this stuff, but also partially just they need all their free cash flow to build out the infrastructure for these opportunities. And so
that's a very important point. I mean, the CapEx, the capital expenditures on this are enormous.
Yeah.
And we went through almost a whole generation where the CapEx there was nothing like that. It was nothing like that in tech. It's really turned. Okay. Go
So
ahead.
they're spending. So here's a chart on that. So they're spending, $300 billion a year on just like building out these opportunities, and it's only escalating from there. So it's actually been a major factor in our GDP growth, just that build out, and how much we're spending to build it out. Because I mean, like you think about, I mean, like NVIDIA obviously being a rocket ship, but it's like I saw a chart the other day, and this is crazy. I mean, like it's it was amazing. Like it's like 26 times forward PE. So NVIDIA is 26 times forward PE, growing at like 100% a year or something crazy. Which like, in my mind, I'm like, well, NVIDIA is really expensive, right? But that's like, they had a chart and I was like, okay. And then, and Costco is trading at 60 times forward PE. And you're looking at that and you're like, how does this make sense? Like, because like the whole point was like, is NVIDIA that expensive? And the like, you're like, well, is this going to tip over? Because that's the other argument. Are they actually going to be able to do this forever? So
well, it does raise a question that, explain forward PE. Okay, so forward PE is the price of the stock relative to the expected earnings going forward, not what they've earned like in the last year, but what the expectation is based on the companies and also, I guess, the analysts' assumptions about where they think earnings are going, right? So, so a forward PE is arguably speculative. We depend on our analysts to not be completely crazy about those things, but where traditional price earnings is what's actually happened in the last 12 months, trailing 12 months.
Yeah.
But I have a question for you, speaking of speculation, Josh, because this keeps running through my mind. So forgive me if I sound like someone who's old. I was around in the late 90s, early 2000s, right? And there was an enormous build out of infrastructure for laying fiber optics. Company Global Crossing keeps the name Global Crossing keeps coming to mind because they were one of the ones who built these fiber optics across. And so it's an enormous amount of capex built, and suddenly there wasn't. It was like suddenly, like it's like the Wile E. Coyote ran off the cliff, looked down, and there was nothing beneath him. And of course, that was part of what the .com bust, etc. where things it was clearly a bubble. So what I want to ask you is, what would have to happen for this to be a bubble? For this to not, what would have to happen? What thing would have to change for all of these projections of power building necessitated by AI to not be accurate? Like what could go wrong?
Um, I'm sure a lot of things can go wrong, and it's probably going to be something that we can't even foretell at this current point in
I
time.
know, but I'm desperate for conversation partners,
Yeah.
Josh. So humor me.
So the one thing is, if some company gets so far ahead of every other company and can just crush all competition, is my scariest outcome. That's actually like the terrifying thing, is like if somebody gets their, and this is why all companies are spending so much, because there is this possibility that it's a winner take all situation.
Okay. Yeah.
And this is
it's an
my
arms race.
I actually don't like thinking about it too much, because it actually like is pretty depressing. But it's like there could be a situation where, if you think about it, like with what AI capabilities are going, what they're shooting for is, essentially like full like ability to essentially do everything, like, and surpass all knowledge of all humans. And
Yeah, the great singularity. Yes.
yeah,
Yes.
and
So
so if
called.
you get to that point, you can like, so here, this is like essentially like, think about Microsoft or any AI company, Google or OpenAI or whatever, and you build a business and it's a software business, and they can essentially like take all your code and pull it off your website and take all your capabilities, but then put it through their enterprise distribution sales engine and essentially recreate your business in a day. And like, you cannot stop them.
Mhm.
And like, then they just take over every smaller company who can't stop them, and
Mhm.
until they take over, a good portion. And then do you go into monopoly stat? Like, these are the kind of scary things where you're like, because even like you see this in the VC world right now, where they essentially realize that these big companies can essentially replicate these business models so quickly of anything innovative, and have these massive distribution sales forces, and can add in that feature that you thought was so novel and you were building your business on in literally a week,
Mhm.
through AI generation. And you're like,
Mhm.
that's the scary. And then it's like, well,
Mhm.
is it only going to be that company that needs all this infrastructure, or does it actually need to be distributed across
Mhm.
every company needing this
Mhm.
infrastructure?
So it's what's good for the power business is a whole bunch of companies needing this power. What's bad for the power business is a single monopoly that controls all of this. And so it's yeah.
So, and
What about
that's for, yeah,
yeah.
I don't want to scare anybody. That's just like,
No, 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 no. Listen. You need to know your audience here. These
yeah,
people are already
yeah.
terrified. Trust me. I know these are my friends. I know these people. We're all looking at this, going, well, But I mean, I think that I don't want to get dark. I
Yeah.
just want to ask, like, and I guess sort of from a macro perspective. I guess the other thing would be if there was some technological breakthrough that dramatically reduce the power need of these chips, right? I mean, that could also mess with this a little bit, potentially.
Yeah, I guess if there was some massive power breakthrough, yeah, of course, that's going that. If there's a massive power breakthrough, then everybody on this call would probably be pretty happy too,
Yeah,
because it's
right. I
essentially
mean,
like,
there'd be the other side of that would be
yes,
awesome. I mean, it's not
yeah,
all darkness. I mean, this is a
yeah,
great,
yeah. So it's one of those things where, if there was a massive power breakthrough, that would be obviously something huge for the world.
yeah,
But
yeah,
it would obviously crush investments and anything power, but that would be across all power assets like oil.
yeah.
I mean, the
And we
whole
would have
state
turned
of
our
Texas would be
attention.
crushed. Yeah.
Yeah,
So,
yeah, yeah.
what,
So really, go ahead, Josh. I didn't mean
oh,
to
I was
go.
just, it's funny, like, because the interesting dynamic of this is, because during Trump administrations, actually the price of oil has always gone down,
Yeah,
pretty
yeah,
dramatically. And so
Yeah.
I actually don't know if the oil guys like it that much, like, because they're like, oh, we're just making actually less money.
Yeah. I mean, and all of the like bring on more capacity. They're like,
Yeah,
no, thanks very much. We have to
exactly.
have oil at a certain price or it just doesn't make sense. Yeah,
Yeah,
exactly.
yeah,
Um, okay, so certain power and infrastructure as an opportunity. And the other thing, to just go back to your original example of the interconnection queue, if you do think to yourself as you're listening to this, wow, by 2030, maybe this will have run its course. These interconnection queue opportunities are pretty relatively short term. I mean, these are like 2 or 3 year kinds of
yeah,
things. So you're not tying your capital up for forever, right? I
yeah,
mean,
yeah.
and
And it's gonna,
presumptively there's going to be more.
yeah, these are, unless they solve and are able to get these through the process faster, these are going to be an issue for the next 5 years, just because there needs to be so much new power coming onto the grid.
Yeah,
It
yeah,
takes a lot
yeah.
of work to just put new assets onto the grid, and our
Right.
grid is delicate and
Yes.
needs a lot of work, but it's not that easy to build infrastructure. It's really expensive. So
Yeah. Yeah. Speaking of delicate, before we close, I want to
yeah, yeah,
point to a recent investment that some of our clients participated in regarding these battery arrays and the
yeah,
delicacy of so you have these data centers that are pulling enormous amounts of power.
yeah,
They're pulling it off the grid, but tell me if I have this right, but the data centers power usage isn't just steady, it peaks
yeah,
and valleys, right?
yes,
And so if you've got a lot of power coming in and suddenly you have a valley and you got all this power rushing into the data center and nothing in between the grid and the data center, it can knock out the grid, right? Isn't that what
yeah,
happened? That's what you told me. That's what
yeah,
happened in
yeah.
Spain, right? Right?
Yep.
Yeah.
Yep. There's too much power on the grid in Spain, and then it knocked out the grid and blacked out. I think and it was for like a week or something.
Yeah.
But
It was a
uh,
very serious.
but when you're thinking
Yeah.
about like these big this wasn't an issue when the data centers were like 10 megawatts and
Yeah.
15 megawatts. But when they're 200 megawatts and you essentially are powering the city of Denver, then when the AI data loads go down and you need to redistribute that across the grid, there's no but you have to get power off the grid. So it either needs to be consumed or put into a battery, like, or it goes through the substation and blows the substation. So these are massive amounts of power. And so you put these data or these massive battery arrays in between that to essentially stabilize the grid so that if it comes in and the data center is not using it, it can power the assets. On the back end of that, the grid loves this because essentially if you have an issue where you have a massive heat wave or a cold snap, where people are turning on their ACs or they're turning on their heaters and that's straining the grid, then the grid can prioritize, residential customers over prioritizing the data center customer.
And it has the battery array.
Yes.
So it's a huge opportunity just in battery
Huge,
arrays,
huge.
right? Because every huge data center is going to have a battery array buffer,
Yes,
basically,
exactly.
correct?
Yeah, because in the past it was only small battery array buffers. Like essentially, if the data center went down, you'd get 6 minutes to turn on your generators, your diesel generators, to generate the power that needed to like power the data center, so that they could have so your internet doesn't go down essentially. Because
Hmm.
if a big data center goes down, then your internet goes down because they're all running on AWS or Oracle or Google or Microsoft, and so but now you need these big battery arrays to essentially create this stability across the whole grid. So
Right, right. Well, we really went deep on power.
yeah,
Obviously, power is not the only type of investment opportunity available that is
yeah,
both impactful and also non-publicly traded. But it is an interesting issue. And it's so ubiquitous and it impacts our lives so much. And I think most of us, at least myself, I've learned a whole lot in talking with you before and even more today. And it's not very sexy, right? It's not like,
yeah,
ooh, but it's really important. And it's
yeah,
really important as individuals and citizens that we kind of understand what's up with this and what's happening and
yeah,
all of the implications. I see one question here from
yeah,
Beth, or one comment, that in Georgia and Southern Company, they have decentivized customers using solar and only invest in large solar fields for data centers. As a solar power producer, Beth, myself individually, you are correct. There was a period where it was like if I had extra power and I wanted to send it back to the grid, they would offset essentially dollar for dollar my power bill. They no longer do that. Now it's like, I don't know, some very small fractional piece.
Yeah.
But what I did was put in a battery. So I don't care about, so I send a bunch of stuff back to my battery, and then my battery powers my house on at
Yeah.
night or in, you know, I still have a power bill, but it's relatively negligible. But
Yeah,
yes.
and that's the case almost in most states actually now. Even like, so it's called net metering, where you send power back to the grid and they pay you for it. Even in California, they've essentially taken away like your ability to, because so many people got solar, and then they're like, we can't pay all
Yeah.
people for this solar, and so
Right.
because it was just like too much out of their pockets, and so they essentially stopped, or it's like a very small percentage for net metering. Like you use your own power, get a battery. So yeah.
Yeah. Yeah. The solution is a battery. And they kept saying, don't get a battery, don't get a battery. The batteries are going to drop in price. Well, I finally gave up. And I don't know, Josh, that the batteries are going to drop in price. Batteries going to drop in price, or with the demand being what it is,
Well, it
maybe
just
not so
depends. I
much.
mean, like retail batteries are a lot different than like massive
Yeah.
batteries. 'Cause massive batteries
Yeah.
have actually dropped in price, just given there's commoditized product in there, which is lithium, and lithium has
So,
dropped. And so they, like, even with the new tariffs in place with China, like battery prices have stayed relatively stable. So
right.
apart. So
Right.
yeah.
Well, I see we're at time. Thank you. The audience has like hung right in here with us. I was waiting, like I was afraid we were going to start to lose them at like data center.
Yeah.
But we didn't, Josh. Good job. That's great. I actually do find it pretty interesting. Wait a minute. Okay, we have some questions coming in. For those of you who want to stick around, let's do some questions. Are these battery arrays typically owned or operated by the data center owner, like Meta or Google, or does the utility own them? Can the stored energy be pulled back into the grid during peak events, or do the data center owners get to hoard, hoard that for their own peaks?
So it's usually in our case, it's an outside provider who's like essentially providing, this is a brand new solution. So people didn't fully realize they needed this until more recently. And then there's like with these big contracts like Stargate, they realize they actually need these. So it's owned by a separate company. And it's usually going to be the builder of the data center, because Google, Meta like might be like considered the builders, but it's actually, there's another company behind them who's actually doing the work. One of the big ones in the industry is Crusoe, who's building Stargate and a number of these other big data centers. But they're not going to be owned by the utilities. I guess they can get a contract from the utility, and the utility would pay them to like push power back to the grid. In likely cases, they will hold the power for themselves, and the utility prefers that over like pushing power back to the grid. So because then like they can deal with their own loads on their side, and the data center can be a good customer where peak during the day they can maybe reduce their load to the utility, and they can use their batteries, and then on the off times, usually at night or in the mornings or at night, they can utilize utility loads. So yeah.
Right. Yeah, and I would say that you know, uh energy like money is going to flow to the best price, right?
Yes.
If you're sitting right, so whoever's owning the data center, if they have a surfeit of energy and the utility is willing to buy it, and the utility wants to buy it, it's probably going to flow back. Like there's going to be this sort of leveling off, I would guess.
Yes. Yeah.
But it does raise the issue. I mean, the issues you've raised make you wonder about um, the impact on our broader electrical grid of these things, and the need to get out in front on things like these battery arrays so as to not have a Spain-like event
Yeah.
in the absence of those safety features built in that the grid could. And it also just makes you realize how incredibly dependent we are on all of our things. I mean, the idea of our internet going down for an extended period of time, for example, or a grid being compromised for an extended period of time is rather terrifying.
Yeah.
We're so used to being able to communicate that way. It's really, really, yeah. So That's another conversation for building in energy resilience on an individual level. We'll have you back and we'll expect you to have answers, Josh, even if you don't have investments for us.
Yes, I would love to have that. And I see this one last question. I can hit it
Yes,
quickly.
please. Please go ahead.
So data centers, most of them are trying to use renewable energy, like the companies are like, Meta, Oracle, Google are trying to use renewable energy. That's part of their like ethos of like trying to be good stewards. There's a broader definition for that for some of them, and they're still in a competition. So they will use a lot of natural gas is likely the case, which it's and everybody, there's different views on natural gas, but it's an offset of like what you're doing within the fracking network of like Texas usually. And so if you're putting a data center in Texas and essentially not releasing the natural gas into the air just dramatically, that might be a better use of like actually utilizing the resource. I mean, it's not perfect. They usually also, a lot of them are putting like special carbon dioxide capture technology on top of their natural gas turbines to hopefully offset some of that usage, but it's going to be part of the whole solution. So,
I mean, I'll speaking for myself, I do feel like you have offered us some positive news here in the sense that industry overall, despite the sort of, chat about not caring about this or that, renewables or tax incentives, that companies are finding ways to utilize this more and more because it's a cheaper and cheaper use of energy.
yeah,
And so that's a, cold comfort perhaps for some of us, but it's a comfort nonetheless that
yeah,
that's actually happening in the space.
yeah.
Before we go, any further questions or comments from anyone? We want to give you one more shot before we sign off. Any other questions? Going once, going twice. Josh, I really appreciate your time. This has been a
Yeah.
great conversation. Thank you so much. For those of you who are on the call who are Chicory clients, if you are interested in these sorts of things, please reach out to your advisor. We're always monitoring what Josh and his platform have to offer and trying to bring you opportunities that we think suit you relative to your own time frame, risk tolerance, the particularities of your situation based on our financial planning. But always good to get educated on these things.
Yeah.
So thank you. Thank you very,
Thank
very
you so
much.
much. Great to meet you all. And let me know if you have any questions follow up.